Charger. Now we can kick off. I see a good quorum there. So now. I hope mshapanda miti. Hata chika mnapigia kuendea miti. So ngoja tumalize hiyo swali. Where is it? Yes, I got it. So I'll read the question. I will read the question. That is December 2022, question 5. I hope everyone is there. I just hope everyone is at that question. So the question says, and I read, the following draft financial statements were extracted from the books of Mrima Limited as at 31st, not really. The following draft financial statements were extracted from the financial records. Financial records of Malum Limited, a public limited entity, as at 30th April 2022, with comparative for the year ended 30th April 2021. So, statement of financial position. Statement of financial position. So statement of financial position, we have 2022 and 2021. Then we have the statement of profit or loss for the year 2022. Let's check the additional information. Malum Limited acquired some new plants during the year to 30th April 2022 at a cost of 18 million from a finance company. An arrangement was made at the date of acquisition for liability for the plant to be settled by Malum Limited, issuing at par a 10% loan note dated 2025 at the finance company. The value by which the loan note exceeded the liability for the plant was received from the finance company in cash. So next, the company's motor vehicle carriage fleet with a cost of 2630 and accumulated depreciation of 1165 was disposed of during the year for cash proceeds of 1810. The profit on disposal has been included in other operating expenses. Depreciation charged on property, plant, and equipment during the year were 5490 and was included in the cost of sales. Intangible assets were amortized during the year, and amortization charged profit or loss amounted to 540. During the year ended 30th April 2022, Malum Limited made a bonus issue of ordinary shares of 1 new share for every 10 shares held, utilizing the share premium account. Required a statement of cash flow for the year ended for Malum Limited for the year ended 30th April 2022, using the direct method in accordance with IS number 7, 20 marks. 20 marks. So let's start. Let us start. So you write here, Malum Limited, statement of cash flows for the year ended for the year ended 30th April 2022. So let's operate one column, shillings in thousands. Shillings in thousands. Then you start with operating activities. So operating activities. Operating activities, you go for profit before tax. So how much is the profit before tax which you can see? How much is the profit before tax which you are capable of seeing? Check the P&L. $81.90, Olivia. Profit before tax, I agree. It is $81.90. So you give us here 8190. That mark nataka kila mtu apate kwa mtihani. Don't miss it out. Then you say adjust for. So adjustments. So adjustments, I told you one of the items you need to check is depreciation. So depreciation, check note 2. Note 2 in the question paper. So note 2 in the question paper, depreciation, you will see there they are charged 5490. So you add back 5490. The sister of depreciation is amortization. So that amortization, you also need to bring it here. Amortization. Amortization was mentioned in note number 3. Check note 3. So that one is appearing in note 3. So in note 3, amortization is 540. You add. Check whether we gained or we lost on disposal. That one, check note number 1. Excuse me, 1 number 2. The company's motor vehicle, that note. Can you check that note? I want to check whether we gained or we lost. So they are saying there was a motor vehicle with a cost of 2630 and the accumulated depreciation was 1165. Was disposed of during the year for cash proceeds of 1810. So they received 1810. Can you check the net book value? Take 2630 minus 1165. That one will give you how much? 2630 minus 1165 comes to how much? So you get 1465. So the net value was 1465. Then it was sold at 18. So they gained. So that gain is not an operating income. You less it. So gain on disposal. Gain on disposal. They received 1810 when the net book value is 2630 minus 1165. Again, of how much, student? 345. Marianne, Joshua, am I 345? Yeah, kitambo. No, you're the difference. 345. So 345, you subtract. You subtract. Very good. Very good, very good, very good. I go to P&L. Students, let's go to P&L. So P&L, you go to where we have the profit before tax. You go upwards. You check for items which are not operations. I want you to mention them there in the text. Can you mention for me items which you think are not operations in the P&L between revenue and profit before tax? Which ones do you think are non-operating so that I can adjust them? Mention them by names. Which are the items between revenue and profit before tax, which are not operations? Which ones do you think they are? Which ones do you think they are? That quietness means you check between revenue up to profit before tax. There are items which are non-operation. Which ones are they? Only operate, we have, let me check, other operating income, government grant, that is true. The other one is finance cost. Yeah, those two. Those two are not part of operations. Revenue is okay, cost of sales is okay. Other operating expenses are the admin and distribution. So the ones which are non-operations are the two which already say the finance cost and the government grants. So government grants, you don't receive that on daily basis. So you remove it out. The 750 is not part of operations. In operations, una any revenue, cost of sales, admin, distribution. Admin and distribution sometimes you are operating expenses. The rest you check out. Finance cost, that is 705. That one you add back because they are subtracted, so you add it back. So how much do you get as cash flow? This is the cash flow before working capital changes. How much? So 13,830. Let's go to working capital. For working capital, in fact, I want you to do it for me. You check inventory, receivables, and payables. You just tell me increase or decrease for the three. So I want to see your answers. So for the three, you just tell me whether it is an increase or decrease. That is inventory, receivables, and payables, those three. You tell me whether it is an increase or decrease. Chap, chap. Olive, all of them are increase. Thank you. If all of them are increase, so you just be giving me the figures. You'll only give me the figures. So increase in inventory, increase in receivables, get the differences, increase in payables. Those three. So the differences will be 13,300 minus 11,445. Receivables is 9230 minus 7080. Payables is 10,200 minus 7770. So I'm seeing all you giving me answers there, you confirm. 1855, you less. Increase in stock means you are buying more stock. 2150, it means we are selling on credit, but we are not collecting. That is why the receivable is going up. 2430, that one you add. It means we are not paying, I believe you are. So you will adjust for me this if they are okay, and give me the figure. So you adjust from 13,830. you need to adjust from 13,830. So from 13,830, now for 12,255. 12,255 from 13,830. Confirmed. Marianne, we're unapata 15,455. Joshua and Olivia is getting the same answer. One more person. One more person. One more person. We're just adding from 13,830 minus that plus 24,30. Linda, Daniel, 12,255. So Marianne, check your side. Check your side. So that one is 12,255. 12,255. Then you say tax paid. Tax paid. I'm not going to waste my time outside there. I'm going to forget to working. Let me show you how it is done. So have a working outside there. Call it tax paid. No taxation, no tax paid. Just call it taxation. Just call it taxation. So you say balance brought down. So balance brought down, you add both deferred and current tax. Deferred and current tax. So deferred tax at the beginning, you start with the beginning. Deferred tax, you will see 810. And the current tax, you will see how much. How much are you seeing for current tax at the beginning? How much are you seeing? 2775. Correct. 2775 and the current liabilities. That is true. So if you add the two, what do you get? What do you get? When you add the two, so that you get the total liabilities at the beginning. 3510 ama 3585. Now Olivia Joshua. 3585. Joshua, check the side. 3585. You add tax for the year. Tax for the year. How much? Check P&L. Check your P&L. So at the beginning of the year, we were charged, but yet we have an obligation of 3585. During the year, check profit account, you'll be able to see income tax expense of 2655. So it means the total tax should be the sum of opening plus during the year. How much is that? How much is that? $62.40. Skip one line, check the closing balance, balance current down. You combine the deferred and current at the end. Hiyo tax inashindaka wanafunzi wengi, but nataka nyinyi muipate. So carry down, you will add the fund 1920 plus current 2685. How much? It is the one you're saying, well, you work it out. It is the one which is 4605, Olivia? It is the one which is 4605? Sawa, 4605. So tax has reduced. It was supposed to be 62. Kwa nini imeenda mpaka 46 at the end of the year? It means they paid. So balancing figure here is the tax paid. Balancing figure. The reduction in tax from 62 to 46. How much? 1635. So these people paid 1635. That is what examiner is not giving us. That is what they are not giving us. Thank you. So tax paid, I don't know that is working one. They're working yoyote. So that is working one. We have gotten 1635. You subtract. Interest paid. Interest paid. Interest just take the finance cost. Finance cost is the interest. So you added, you added it here, check here. You added finance cost under operation because it is not an operating expense, but subtract it at that stage. So finance cost paid the same amount, 705. So we are done with operating activities. This is A. So this is cash flow. Cash flow from operating activities. How much? How much? $19.15, Joshua. 99.15. 99.15. So before we go to investing, please counter check all the operating come for as well. There is no question. So we are bound to proceed. We are bound to proceed to investing. Investing, niliwaambia tunaangalia wapi? I want to see if someone can recall. What is our main area of focus when we are doing investing? I want to see who can recall it. What is our main area of concern? Correct, Linda. Non-current assets. Perfect. So when you want to work out investing, just revolve around non-current assets and you will be safe, very safe. So before even I start doing anything on non-current assets, I want to reconcile PPE. Mostly in cash flow, PPE, any cash flow, PPE inakuanga tu na issue zake. So how are working, call it working two, property, plant, and equipment. It always requires reconciliation. Always, it requires a reconciliation. So what was the value of PP brought down? Check non-current assets. Just check on the non-current assets. So PP at the beginning was 27 for 50. I hope you can see that. 27 for 50. Correct. Then we go to the notes. Anything touching PP that up accordingly. Yeah, we just bring them there appropriately and in a good manner. So, but before I go to that, I will check under equity. Check for me something under equity. Ni kitu ingine na sawingi in every question. So I need to check it mapema. Mulisema mapema ndio best. Under equity, you are seeing revaluation surplus. Revaluation surplus at the beginning, hakuna. At the end, 25.50. So it means there was a gain for the year. So add revaluation gain 25.50. You top up. Then now we go to the notes. We go to the notes. Note 1. Malum Limited acquired new plant during the year at a cost of 18 from a finance company. An agreement was made at the date of acquisition for the liability for the plant to be settled by Malum issuing a 10% loan note. So hawakulipa cash, walipeana loan. So add new plant, 10% loan notes. So they give a loan note, you certificate to your parents. So hawakulipa in cash, but the value went up. So that is the 18. Correct? Note next. Note number next. The company motor vehicle with a cost of 2630 and accumulated depreciation of 1165 was disposed of. Less disposal. Disposal, you subtract the net book value. So it's 2630 minus 1165. You are given me this figure somewhere, but I've forgotten. How much was it? How much was it? $14.65. That one went. Less depreciation. Less depreciation. Depreciation, we have it 5490. So it means at the end of the year, this should be the value of our assets. Can you work it out and tell me the answer? How much when you adjust? Thank you. 24,845. 24,845. Can you compare with the closing? Balance carried down. What was the closing in the balance sheet? They closed with 36,300. $11,455. 445. Huh? 455. Repeat this 455, 445. 11,455. 11,455. That increase means they acquired. So that is acquisition. Yes, that is acquisition. So there we go. We can do that working. There is no big problem. So we start. Cash received. So go back to the cash flow. Go back to the cash flow. Cash received on disposal. On disposal of motor vehicle. Motor vehicle, when they sold the motor vehicle, that one, they disposed it for 1810. That is cash inflow. Then cash paid to acquire. Cash paid to acquire PPE, property, plant, and equipment. You use the part in working two. That is 11,455. Oh, what are we around? Oh, we were looking for. Happy birthday, the birthday. So 11,455. Then we go to the next item under non-current. Under non-current. Under non-current. Nini hapo? Intangible assets. Intangible, you need to be very keen. Because check note number, you don't know your amortization number. Check note 3 up somewhere there. There was intangible assets amortized during the year amounted to 540. So if others like Kupanya working, I don't want to make your life difficult. Let's just analyze that thing keenly. Opening 6150. Then we amortize 540. We subtract, then we check. All right. So I'm told when you subtract, that is 1140. Huh? You're 1140 again. I'm a 5610. I'm a 1140. 1140 ushafanya yote. So when you take 6150 minus 540, you get 5610. But unaona imepanda mpaka 6,000. These people purchased more intangible assets. That is why it has increased. So I don't want to do a cash paid to acquire intangible assets. So that is 6750 minus, in brackets, 6150 minus amortization of 540. I've seen 1140. So that is cash outflow. That is cash outflow. So have that one. Then there was the element of government grants. There was the element of government grants. I want you to read it in the which notes. Tuliona government grant mahali because government grant is part of investing. Which note is talking of government grant? Can you check for me? I saw government grant somewhere. Or it was not in the notes. P&L, P&L, sawa. I want to check on it. So let's have a working. That one we must do a working. So have it as working 3. Have it as working 3. for government grants. Government grant. So government grants, check under your non-current liabilities. Can you check non-current liabilities and current liabilities? How much was the grant at the beginning? You know it's a liability because you need to refund. So how much? So 24, yes. Long term was 24, while short term, current government grant was 600. Check current liabilities. You can be able to see that. So that one is 3,000. Then during the year, for the year, we got another grant. For the year P&L government grants, in the P&L, 750. So they got 750 as grant income. Now, the grant income, you know, P&L is an income. The grant income should reduce this liability because you see this is obligation while this is an income. So you cannot add it. So you subtract. So it means you should be talking of 22, it is 2250. Yes. Because the 750 is an income. You cannot add income to liabilities. All right, so skip one line, balance carried down. Balance carried down. If non-current is 3150 plus current 810. What is 3150 plus 810? So that one comes to 3960. So it means they received more because why not 22 and 39? So the balancing figure is the grant, government grant received 1710. I can see it there. So grant received balancing figure 1710 there. 1710. So that one you can bring it to the cash flow as positive. So grants received, we are talking of 1710 positive. There is nothing else. Call it B. So can you add and give me the B? That is cash flow from investing activities. So people are getting negative 90, 75. And I'm seeing somehow we are flowing up very well. So let's go to financing. Let's go to financing activities. And I want somebody to tell me, where do we focus when we are in financing? What is our main area of focus? Equity, yes. In the equity and liabilities, perfect. You see, you are going to pass. Hizo vitu tumeona hapo ya kufurahisha ni ngumu kwa kila mtu, so you don't worry. So we go to equity. Let's go to equity. Let's go to equity. Let us go to equity. So equity, you are seeing ordinary share capital. So I want you to combine. Like you're working ordinary share capital at the beginning. You combine with the share premium. beginning, then you compare with closing. Then the difference is in what you got on the issue. So come here and say issue of new shares. Issue of new shares. So you take the closing shares, 75 plus premium, 1350. You subtract opening. Opening is 6 plus 1050. Get me that difference. So you take the total. Olivia is already giving me 1800. Someone also to confirm the same. Someone to confirm the same. Olivia has given me 1800. Joshua has confirmed. I hope everyone has gotten 1800. So the increase in share is what they issued, 1800. Next item, the next item, revaluation was later. Retained earnings, utilize retained earnings to determine dividends. So we were not given, so we can get. So come here and say dividends paid. Dividends paid. Check working 6. Let's do a working for that. It's something you can do here, but because in the last question, we never did it, so it is good if we can solve it. Right now, I show you how you get dividend. So have there working 6. Retained earnings. Decrease in retained earnings is dividends. That is working 4. One working 5 in the government grant. Whichever working, you just name them. There is no problem. Just name them. Other company working 4 on which one. So let's go to retained earnings. Dividends, should profit go down, decrease in profit without communication is dividends. So what was retained earnings brought down? Check the retained earnings brought down. Retained earnings brought down, I'm seeing 25, 980. 25, 980. Good. For the year, you add profit for the year. For the year, you check P&L in the profit account. Check profit account. So in the profit account, the profit for the year is 55.35. So how much should the total profit be? Add the two. Add the two to get the closing profit. That plus that will be how much? So that is 31,515. 31,515. Skip one line. Balance carried down. Check the retained earnings at the end of the year. 28,065. So the decrease Decrease in profit is retained earnings. So the balancing figure is dividend, sorry. Decrease in profit is dividends paid. That is the balancing figure. The decrease from 31 to 28. $34.50. So I've been told this is $34.50. That is the dividends paid. So in the event you have not been given dividends, you consider the opening plus profit for the year, you compare with the closing. As simple as that. So dividends paid is $34.50. That is cash outflow. That is cash outflow. Good. Good. The next item, equity is over. Equity is over. The only item remaining which we have not worked out is the 10% loan notes. The 10% loan notes. That is the only item remaining. So loan notes, start kufanya hiyo working. I want to explain. At the beginning, loan note was $52.50. Then there was note one. Was it note one or which note? With another loan note, note one. Walipeana another loan note when they were acquiring that asset of 1,800. So take 52.50 plus 1,800. That is how much? 52.50 plus 18. At the beginning was 52.50. During the year, they gave another loan note to acquire another vehicle, 1,800. So even that one comes to 70.50. We closed with a loan note of how much? 82. That increase means they issued loan notes for cash. So right there, cash on issue. Cash on issue of loan notes. So how will you get it? Simple. They closed with 82.50. They closed with 82.50. They closed with 82.50. Beginning was 52.50 plus 1,800. So the difference. So take 82.50 minus what you got, 70.50. So that increase is what they issued. Increase of how much? 1,200. So that is cash inflow. We are done. Call it C. That is cash flow from financing activities. So people are getting negative 450. Negative 450. So get for me net cash flow. Net cash flow is A plus B plus C. So people are getting positive 390. So I want to take it the other side. Net cash flow. Net cash flow. A plus B plus C 390. You bring cash and cash equivalents brought down. Then you get cash and cash equivalents carried down. So are we given? Yes, check your current assets. Check your current assets. So here in the reconciliation, again, it is direct. Cash and cash equivalents. So if you take the beginning is 510. So if you put there 510, will you get their closing? The closing cash and cash equivalents, if you add, it is reconciling, it is in order. Yes, it has reconciled at 900. So that is perfect. So let cash flow rest there. Wewe revise tara na hizo mbili naongezea moja. The way I say, I'll add you another one. Probably nikitulia leo bado nimechoka. Maybe kesho. For published one, this one also I'll add you one. The video plus the computations for more revision. But I don't know. I can tell you are not like so blank in cash flow. Ikikuja, hamtakuwa mbaya. So it's either they bring both cash flow and published in that paper or one of them, but both will not miss. That one I can assure you for a fact. Both won't miss. That one, you can take it to the nearest bank. Both can't miss. Either one or both. Either one or both. So preparation, equation. You prepare accordingly. And the way I know you people, those are small issues. Those are small issues. And relax a bit. I think, should I leave you to rest, or I'll share with you the notes on ratio analysis? Remember, after we were supposed to go to branch, but branch hapo kwa ratios kwanza, ndio tuende branch, then after branch is partnership, which is the last stop. So do we go through that handout? Then we do the computation in our next class, or niwawachilie mpumzike. We go through it in the next class, then we start computation. What do you think? Do you still have the energy to proceed? Sasa Linda anangoja Olivia aongee, Olivia anangoja Dana aongee, Dana anangoja Joshua aongee, Joshua anangoja nani aongee, Joshua anangoja Naomi aongee, Naomi anangoja Miriam, Miriam anangoja so Sama say next class, let's go through the notes. Kila mtu ataseme I'm taking the majority. So far the tie, next class, let's go through. So the tie, which is which? So lazima mtu aseme ndio to separate. You know, majority always carries the day. Naomi anasema let's go through. Haya. So even Olivia now has changed. So Marianne, going through the notes cannot take us more than 15 minutes, less than 15 minutes. So I think if we go through YouTube working a computation might be quite easier. It can make our work very easy in the next class. So let's just go through, then we see. Meanwhile, allow me to give you 5 minutes break. Let's meet at 3:46. 3:46. You can stretch out in. Uangalie kama miti hapa hapo nje zimemea, zimeweka matunda, then you come back. We are back. We are back. I hope miti zenyu zimemea hapo nje, mlipanda asubuhi. So let's check have a topic there. Analyzing financial statements. So let's go to the notes one by one. Analyzing financial statements using common sense approach. So we have two ways of analyzing financial statements. We can use common sense approach, or we can use financial ratios. So you can use common size or financial ratios. So in the topic, we are required to check both the two. So common size analysis, also referred to as vertical analysis, is a tool that financial managers uses to analyze financial statements. It evaluates financial statements by expressing each line item as a percentage of the base amount for that period. Wait, sorry, I will break it down for you people. The analysis helps to understand the impact of each item in the financial statement and its contribution to the resulting figure. The technique can be used to analyze the primary financial statements, i.e. balance sheet, income statements, and cash flow statements. In the balance sheet, the common base item to which other line items are expressed is total assets, while in the income statement, it is total revenue. Common sense analysis is computed using the following formula. So percentage of base is the amount of individual divided by amount of base item times 100%. Before I proceed, I need now to tell you what we are saying. When you are told by the examiner that you analyze financial statements using common sense approach, then what you do, if they want you to analyze P&L, then you see P&L tunakuwa na revenue, cost of sales, administrative, distribution, among others. So maybe you find revenue was 90, cost of sales was 80, admin is 20, distribution is 10. So in this case, when you are analyzing, you check what percentage is these items contributing to the profit account. So you express each of these items as a fraction of revenue. So distribution will be 10 over 90 times 100%. Admin 20 over 90 times 100%. Cost of sales 80 over 90 times 100. Revenue is 90 over 90 times 100%. So in the P&L, when you are told to analyze financial statement using common size, then you express all the items in the profit account as a fraction of revenue. When we go to the balance sheet, then all the items in the balance sheet you express as a fraction of the total assets. So every item in the statement of financial position, you express them as a fraction of total assets, you multiply by 100%. As simple as that. That is what we call common sense analysis. So the only thing you need to know, the base. So base is the total assets in the balance sheet. The base in the P&L is the total revenue. As simple as that. There is nothing big. So common sense analysis can be conducted in two ways: vertical analysis and horizontal analysis. So I'm not going to read them, rather just to explain. So when you talk of vertical, you are comparing the same year, the same year, the same company, you express as a fraction of the revenue. That is called vertical. Horizontal, you compare two different years or two different entities. So when you are carrying out horizontal analysis, you compare 2023 with 2022, or X limited with Y limited. That is called horizontal. Now there, balance sheet common sense analysis, I've explained. Income statement common, is what I'm saying. You don't even need all those stuff which are there. What you need to know, when you are carrying out common sense analysis, all items in P&L you express as a fraction of revenue. All items in the balance sheet you express as a fraction of the total assets. So I'm not wasting my time there. So you will check the importance of common sense analysis. That one you will read at your own. That's what you will read at your own time. Even that one. So I'm just going to number 2. These will be the opportunity we student and Number 2 is analyzing financial statements using financial ratios. So common size, whether I used to repeat, you just know what is the base in the balance sheet and what is the base in the P&L. You are good to go. Tutafanya maswali hapa. Number 2, analyzing financial statements using financial ratios. So financial ratios can be classified into 5 categories: investors of valuations ratio, liquidity ratios, leverage for gearing ratios, profitability ratios, and activity or efficiency or asset utilization ratios. So I summarized the ones which are very much common in financial reporting. Some are more or less finance, the same, but there are some which are on FR. Liquidity ratios mostly. These are ratios which indicates the ability of the company to meet its short-term financial obligations. The most common one, but the most common liquidity is current ratio. So hapa ni ground formula, that is the worst part of ratios. Current ratio is current assets over current liabilities. The ideal should be 2:1. Maybe you can be told to comment. So for current assets, your current assets should be twice your current liabilities. So on current ratio, you just take, the way the name says current, you take current assets, you divide by current liabilities. Quick ratio is also known as the acid test ratio. The formula is the same with the current ratio, except current assets you subtract inventory. Current assets you subtract inventory. But the formula remains the same. Cash ratio, not very common. The ones which are common in liquidity are those two: current ratio, quick ratio. Hizo zingine zinakuja once. Zenye zinakuja once tutakuwa tunarefaa. But I want you to master those common ones. So like right now, if you have known current ratio is current assets over current liabilities. Ideal 2:1. Quick ratio, the same, current asset minus inventory over current liability, 2:1. Profitability ratios. These ratios indicates the ability of the company to generate returns in relation to the sales and investments. Good. So one, gross profit margin. You take gross profit, the way the name says, you take gross profit over sales times 100%. Gross profit markup. Markup is gross profit over cost of sales times 100. Return on capital employed is operating profit. Operating profit is profit before interest and tax. You divide by net assets times 100. So net assets is total assets minus current liabilities. The return on capital employed. So you take profit before interest and tax divided by net assets. So net assets is the working capital. You take total assets minus current liabilities times 100. So for profitability are so many. You, first of all, before you think of those many, just master for me those 3. The markup, margin, and ROCE. those three first. Then activity ratios. These are ratios that indicate the efficiency with which the company utilizes its resources to generate their revenue. They include inventory turnover ratio. So for inventory turnover, you take cost of sales over average inventory times, no times. The answer should be in times, X times, turnover. How many times are you converting stock into sales? 2 times, 3 times. So you take cost of sales over inventory. Trade receivable turnover, annual credit sales. Receivable goes with sales. So you take annual credit sales over average receivable, X times. Receivable collection, you just do the reciprocal of receivable turnover. So you take the average receivable over annual credit sales, but you multiply by 365 days. Trade payable turnover, payables goes with purchases, so it's purchases over average payable, X times. Trade payable payment period, the reciprocal of trade payable turnover. So hapo mtaangalia, tukifanya maswali mbili, inakuanga inasinka, NB, average is opening plus closing divided by 2. Hiyo tutatoa kwa notes ilitoka. We take for individual financial periods. Don't take opening plus closing divided by 2. So there is nothing. Actually, hakuna kitu hapo. So utago through tena vizuri. Wewe soma tuzo nimekupea. Kuna a lot of stories huko. Mr. Grant huko. Utasoma vizuri. Then when we meet, we shall do this question. Then I'll forget value out. Let me look for. Like this question. When we meet, we shall do August 2022. August 2022. Okay, these are the questions we're going to do. No, August 2022. Question 5. Question 5. Yes, question 5. We shall also do April 2022. April 2022. Question 2. April 2022. Question number 2. Last setting our calculator ratios, how many in? Let me check. Last setting ni kama ratios was absent. Let me just check. Nione the current thinking of the examiner. Number 1, no. Number 2, no. Number 3. 3 was group. Number 4 was cash flow. 5 was published. So last sitting, it seems. Yeah, the next class is Friday. Yeah, the next class is Friday. So there was no. Hey, now how come the cost that you squeeze a cosine? Ratios are costing nowadays. I don't know why I'm not seeing it for last. Come on, let us hear. Oh yeah, they brought theory. Kuna theory hapo number 1B. Haikosi nowadays, every day it's there. So tutaangalia what they were saying. But hiyo theory ilishawapea kwa theory hangout. I hope everyone in this class has theory hangout. That hangout is around 21 pages. If you don't have, you can request me repost. So tutafanya, I've mentioned 2 questions. Then tutafanya 3. The other one, the last question we'll do. The other question we'll do is December 2022. Right, that one. December 2022. December 2022. Question 4. December 2022, question 4. Naomi is requesting for the theory handout. Well, nani naweza interest haraka? Joshua, can you retrace that you post for people who are not having? Now we make sure your handout itatoka 20 marks. That one I can assure you. 20 marks kutoka kwa hiyo handout. Mimi sijui ni gani. Read your handout kwanza usome properly, proper. Swali itatoka hapo like 20 marks. So we'll do those 3 questions. So you can do Thursday morning, we can do the 3. If we can, the better. If we can't, tutamalizia Friday, Saturday to answer branch, or if we finish well and good. So thank you so much for joining the class. You can continue with your activities. Allow me to compress and send these videos. Have a good evening. We meet on Friday, God willing. So Joshua, unaweza tuma kwa group your handout, saidia wengine.